Hey, Saretsky here. As always, a Canadian real estate market update with particular focus on Vancouver. If you're getting sort of value or entertainment out of these videos, all I ask you hit thumbs up and subscribe. Questions, comments, put those below. You have to excuse me for the quality of this video. I just actually moved, so my place is in shambles. I'm missing my microphone, so I do apologize here with the makeshift background as well. Hopefully be all set up and ready to go by next week. But I wanted to update you guys on my video last week, which was basically talking about the Canadian bond market, how that was influencing mortgage rates, and how that was ultimately going to filter through into the housing market. I think that video is clipping north of 60,000 views right now. So obviously a very popular video. So I kind of wanted to follow up on that because as we talked about last week, we now officially have 4% mortgage rates in Canada. So again, I don't think we've seen those. I think the last time we saw those was back in 2010, 2011. So it's been a long time since we've seen 5-year fixed mortgage rates north of 4%. So basically most of the major Canadian banks, 3 or 4 of them now are advertising 5-year fixed rates just over 4%, about 4.09, give or take. Now, again, your variable rate is still around 2%. What we are seeing is those discounts are starting to change. So you have to keep in mind is that your variable rate is based on the commercial bank's prime rate, which today is 2.7%, and there's a discount on that prime. So right now it's typically about prime minus 0.75, which would bring you to a variable rate of 1.95%. So what you're probably going to see here is the Bank of Canada is set to raise rates on April 13th. They will probably push rates up by, let's say, 25 basis points. So now you're from 195, tack on 25 basis points on top of that. And they'll probably start to see, and we're already seeing, is the banks are starting to reduce the discount off of prime. So instead of, prime minus 0.75, it could soon go to prime minus 0.5 to prime minus 2.5 and even nothing less than prime. So that could be many, many months down the road, but we will start to see variable rate mortgages moving up. Now, the only other thing I want to add as well into this sort of housing thesis is that the other thing to keep in mind here is this is starting to influence the mortgage stress test, right? So, for example, the mortgage stress test, if you don't recall, is 5.25%. or your mortgage contract rate plus 2%, whatever is greater. So i.e., if you decide to go with a 5-year fixed a 5-year fixed mortgage today at 4%, well, you got to add on 2% on top of that. So you're going to get stress tested at 6%, not 5.25%. So what that's actually doing is encouraging more and more people to go variable. So this, the OSFI stress test is actually basically pushing people into variable rate mortgages as a result, because if you're going variable, well, hey, you're still being stress tested at 5.25%. You're now able to qualify for more. And I think, as everybody is aware, is qualification is tough in this market. You've got elevated prices. You're seeing more and more parents having to co-sign to help people get into the housing market, leverage their existing home equity, come up with larger down payments. So pushing that stress test from 5.25 to 6 is going to reduce demand further. So that's kind of how I'm watching this housing market moving forward. Again, housing markets take time to sort of adapt. What we are starting to see is, regardless of what happens with mortgage rates, we know that over the last 2 years, we pulled a lot of demand forward, right? We've had back-to-back years of record home sales. So we're now going to start to see is the rate of change is going to change, and that's going to play into the media narratives. So, for example, here in Greater Vancouver, which is a market that I work and serve every single day, again, if you're looking to buying or selling, a free plug, feel free to send me an email. But that market is, if you look at March home sales, which the number just came out, you heard it here first. March home sales fell 23% year over year. So you're going to see this media headline that comes out and says March home sales fall 23% year over year. And that sounds really bad. And for the average person just reading CBC News or watching CBC News is going to go, oh my gosh, hey, the housing market's slowing down. Hey, I heard sales are down. Well, it's like, yeah, no kidding, sales are down because you're coming off of all-time record highs from last year. So all they're looking at is the rate of change is decelerating, but that will play into the narratives moving forward. Keep in mind that central bankers never predict recessions. They're always well behind the curve. They're too late in tightening rates, and they're going to be too late in reversing course, in my opinion. So I think they're going to raise rates here in April. I think they're going to continue to move forward because all the data that they have really is backward looking. Like if you look at any of the housing data that comes out, it's still going to show you that prices are going up. But in fact, the market has peaked for the most part across most of the product, but that won't start showing up in these home price indexes for several months, and then again it takes time for those corrections to then show up in that data as well. So these central bankers are always backwards looking, and the one tail sign of that is we look at what the bond market is telling us. Which the bond market is telling us that, we're going to have aggressive rate hikes here and it's going to lead us into a recession. We're going to have rate cuts. Yes, you heard that right. Rate cuts sometime in 2023. So I don't have the data in front of me for Canada, but all we have to do is look at the U.S. So as we know, we've talked about the yield curve before, but the 2s, 30s, so your 2-year bond versus your 30-year bond has now inverted. The last time that happened was 2007. Of course, you tell me what happened in 2008. I don't know, a global financial crisis. Now, that's certainly not something that I'm predicting. It's certainly not something that's in the base case. That's kind of a once in a generational crisis that we had. But I think the bond market is telling us something, which is these guys are going to tighten. They're tightening way too late. They're going to tighten aggressively into a recession. And I think it's going to take a lot less than the 9 hikes, again, that they're currently pricing in. But that's what they're pricing in. And so all you have to do, again, is look at, the probabilities of recessions here are moving higher as well. And so that's kind of what everybody seems to be talking about now. It seems like everybody's kind of getting into the bearish camp here. So, watch that yield curve moving forward. And, hey, this is important because everybody comes back to me and says, well, Steve, who cares? if housing drops, 20%, big deal. That only takes us back, 12, 15, 18 months ago. So if they drop 20%, it's probably not a big deal, right? The economy and the market will just digest this and we'll kind of keep going on. Everybody will still be employed. Everyone's still going to be having cocktails, feeling good. And that's just not the reality. The reality is real estate. Yes, real estate accounts for 50% of global wealth, not Canadian wealth. 50% of global wealth is directly tied into real estate. So if you have declines in real estate, goodbye to your wealth effect, goodbye to the additional spending that comes with that wealth effect. And so this is why real estate corrections are not like stock market corrections. Stock market corrections, you can, for the most part, can kind of move on your merry way. 10-15% correction in the stock market is just kind of par for the cause. But in the housing market, there's so much tied to that, right? 69% of Canadians own housing. And so you have, and not only that, you have to think about this. This is bank collateral, right? You have to understand, how do banks make money? Well, banks make money and they extend credit into the economy. Credit is the lifeblood of the economic engine. You don't get economic GDP growth without creating new credit. And you create new credit through bank loans. In fact, bank loans make up 98% of all new money that is circulated into the global financial system. So, when you have real estate declines, well, that's because home sales dry up and liquidity dries up, i.e. banks are not issuing loans, or people don't have any desire to basically borrow loans. And so the credit impulse basically starts to decline. And so you have this sort of, you don't have credit pumping through the system, which again is the lifeblood of the economy. That is how money is created. That's how what moves. And you guys might say, well, that's kind of a Ponzi scheme. Doesn't that mean you have to keep growing your credit and your debt? Yes, it does. The idea is hopefully you try to direct that credit into productive portions of the economy, such as, new businesses, mom and pop, small business, medium-sized business. You ideally don't want all that credit issuance going into housing, i.e. a non-productive asset. But that's obviously what we do predominantly in Canada. So that's kind of the framework that I want you guys to sort of understand and look through things as we move forward here. The long story short, to sort of summarize here, is, again, mortgage rates are going up. Central bankers are well behind the curve, so markets are basically pushing them to raise rates. The central banks, because there's a lot of political pressure and because, political pressure because of inflation, is that they're going to continue to tighten, and they're going to continue to tighten into, in my opinion, a recession. And the yield curve is telling you that we're going to be looking at rate cuts in 2023, 2024. And so that's why, still, my opinion is I think that people are, the big banks are ultimately scaring people into these 5-year fixed rate mortgages when there's still a 200 basis point discount on your variable rate mortgage, when I think a recession, may not be imminent, but I think the housing market will lead us there. Again, 50% of global wealth, a significant driver, roughly 20 to 25% of GDP in Canada. When your largest economic sector begins to contract, that will have ripple and knock-on effects across the economy. So hope that helped. As always, we'll see you next week. I apologize for the setup. We'll have a new one next week. See you soon.